Ryanair is Europe's leading low-fare scheduled passenger airline. Its main strategy is to provide low-fare, excellent customer service, frequent direct flight on short-haul routes, and low operating cost. The two variables that we will be comparing against the oil price is Ryanair's share price and its competitors' share price. Firstly, let us examine how the oil price changed over the years. The graph shows how the oil price changed in the last 10 years. As we can see, the oil price dropped dramatically in 2009 and end of 2014. Now we will focus how the oil price changed in 2014. In 2014, the oil price dropped from $111.87 to $48.42 in the last two quarters. And this graph shows the inverse relationship between the oil price and the share price of Ryanair. While oil price in 2014 is high, share price of Ryanair dropped. In 2014, the cost of oil accounted for 46% of total operating costs. Because of the increasing price of oil at the beginning of 2014, Ryanair suffered a €128 million increase in fuel bill. Due to high oil price, the net profit after tax decreased by 8% compared to 2013. Ryanair may not benefit much from current low oil price. This is because they have hedged their oil at a price nearly double the current oil price. Hedging is a contract that an airline makes with their oil supplier to buy oil at a predicted price in order to protect themselves from high oil price. Ryanair has hedged 90% of fuel needs for the year ending March 2016 at $92 per barrel. This is lower than the price they hedged in 2014, which will deliver around €15 million cost saving this year. However, if they bought oil at the current oil price, they could save €200 million more. One of the factors that affect oil price is world GDP. We have looked at data provided by the World Bank to see how world GDP affect oil price. The graph shows how world GDP changed over the years. Then we will focus on the GDP prediction for 2015. We have used our studio to work out the correlation between oil price and world GDP. We can see from the diagram, there is an inverse relationship. This graph shows prediction made by different experts on oil price for 2015 and 2016.
We can observe on the first graph the supply and the demand curves in 2014 before the price drop of August 2014. P star is the price then and Q star the quantity. On the following graph, we can observe the consequence of an increase in supply. Indeed, supply increase of 2 million barrels per day in a year. In August 2014, the supply was higher than the demand due to the important USA shale production and the refusal of OPEC countries to slow their production. The demand growth was only 0.7 million barrels per day, due to a small mondial economic growth and particularly in emerging markets. On the graph, we can observe that in this situation, the price decreases and according to the supply growth, and the new price P star prime is the current price in January 2015. Supply will keep on exceeding demand in the short term, which means in 2015, according to EIA forecasts. However, due to many factors, consumption should outpace supplies in the long term. Indeed, the low oil price is sustainable for OPEC countries, but isn't for other countries for which the high cost of production will lead to a diminished production. Moreover, the oil price drop will boost the world economy. by raising purchasing power and the demand of oil importers, but its impact is going to be truly contrasted between oil exporters and importers. However, this economic growth might not be as important as predicted, considering that some negative factors, investment drop, market volatility, stagnation in the Eurozone and in Japan, geopolitics risk, could compensate it. Hence, the predicted growth of October 2014 has been reduced of 0.3% according to the IMF World Economic Outlook update of January 2015. On the last graph, we can observe that the slight increase in demand and decrease in supplies lead to an increased price, which will happen in December 2015. We are going to calculate the price elasticity of the demand in order to predict the variation of the price and therefore the price in December 2015. Using historical values, which are the mean of the world consumption during the first trimester of 2013 and the first trimester of 2014, as well as the mean of the oil price during the first trimester of 2013 and 2014, we calculate the elasticity of the demand with the formula variation in percent of oil consumption divided by variation in percent of oil price. Using the number we just found, and by changing the equation, we can calculate the change percent of the price between December 2014 and December 2015 by using the predicted world oil consumption during the fourth trimester of 2015. As the price change is 6.3%, using the price in December 2014, we calculate the new price of oil in December 2015. However, some factors may affect the behavior of the price during 2015. One of them is the economic growth in China. Indeed, China is the second largest consumer of oil in the world, but due to its slow economic growth, it might not consume as much oil as predicted, and therefore the demand might not increase as much as predicted, which will impact the price. The other factors that could impact oil price are the American shale, because it is unsure whether the USA are going to increase their production or not. If they decide that they keep their production level despite the low price, the supply won't decrease as much as planned and the price will not increase as much as predicted, or will increase in a longer time. Furthermore, for now, countries refuse to cut their production, but we cannot be certain they are not going to decrease it at some point. Finally, the geopolitics could impact the oil price. We can't predict whether a geopolitical event will happen or not. Finally, we can predict the oil price in December 2016 by using the predicted price change of the IMF, which is 0.6%.
EasyJet has seen an increase in the number of passengers and has recently announced its plans to cut fares by £2 on average. We calculated that Ryanair's share price is $793.18 in 2015 and $2,253.5 in 2016. Excel to find a relationship between EasyJet's profits and Ryanair's profit. We have also found a linear relationship between EasyJet's share price and its profit price. EasyJet's share price in 2015 is 1,916.68, while in 2016 we predict that it will be 7,383.159.